What is going on, you guys, and welcome back to another video on the channel. You may be wondering two things. Why am I filming this video in my house? And for those that have been subscribed to the channel for a while, drop a thumbs up. Drop a thumbs up if you know who that is sitting over there, or this, I guess, or this little bugger. I'm trapped in my house because we here in Vancouver, we are experiencing a pretty severe snowstorm. And I say severe, this is severe for us. It's probably negative, I don't know, -4, -5. Probably our viewers over in other areas of Canada are thinking this is weak sauce. But I did want to throw up a video today. I couldn't get into the office because my car is completely swamped, but I wanted to talk about one of the most important lessons, especially for our new and our beginner investors. And if I were to pose a question for you guys, saying, if your portfolio dropped 50% today, okay, terrible day in the markets, it's down 50%, but tomorrow is an amazing bounce back day, and the markets are back up 50%, all is good. We've broken even, right? Wrong. Very, very wrong. In fact, this video today, we're going to be covering one of the biggest myths in investing and proving why this chart right here is one of the most dangerous things that an investor can come across. Because in reality, this is much more what it looks like and much more what we have to anticipate when it comes to investing in the stock market. And if you're somebody that is confused and you're not entirely sure what you're looking at with that chart that we just popped up on the screen there, today we're going to be talking about how difficult it is and how understated it can be to recoup losses in the stock market. And I hope that by understanding this and looking into this concept, or this, I don't know what we'll call it, a concept, it may shift your tone. It may shift the way that you invest, especially knowing that we are coming up on this recession that everyone talks about whenever that does happen. And if we just had an example to prove this case, because I know there's some people that are thinking, we still don't, this doesn't make any sense. If you had $100,000 and that $100,000 drops by 50%, that leaves your portfolio at, of course, 50 grand, $50,000. Now, if your investments increased by 50%, which is what they dropped by, although most people think you would break even at that point, that is so far from true, because 50%, a 50% gain on $50,000, that brings you to $75,000. You're 25 grand short of where you started, because in reality, in order to reach back to your starting point, you would require 100% rate of return. You would have to double your investment from 50 grand to bring it back to where you started. Now, to scale this up and to look at the severity of how this chart that you're looking at proves itself, we can go with another example. And let's assume you're somebody that lost 80% of your money in a stock like Aurora, let's say, maybe a company like Hexo. Knock on wood, let's hope nobody out there experienced that. But let's assume you're 80% down on your shares. We'll take the math on that. Your $100,000 is now down to $20,000, an 80% loss. That would require a 400% return for you to break even. Not an 80% return, a 400% return in order for you to get your money back up to your starting point at $100,000. $20,000 plus 400%, that's how you break even. I really hope that that's a lesson that you can take with you when you look at how your portfolio is constructed, when you look at how the strategy that you're implementing in this market. If you're someone that's out striving for a ton of growth and you're not protecting your downside, when the time comes and the markets turn over, if you are somebody that loses 50, 60, 70% of your portfolio because you're investing so aggressively, keep this chart in the top of your mind. And just keep in mind how difficult it is to dig yourself out of this hole. A cool way to display this, I actually just came across this article, which I will actually link down below if anyone wants to check it out, by Canadian Couch Potato, very popular blog here in Canada. But let's assume we applied this to a real life portfolio. And I'm just taking a look here, for example, at the Tangerine investment funds. And this is showing us the data over 2019, how these different funds performed, or how these different portfolios performed, I should say. We obviously have a conservative portfolio with a 70% weighting to bonds. We have a balanced portfolio right in the middle tier, and then we have our growth portfolio. And as reflected by the 2019 return, we of course have the lowest return, a 9.97% in our safer investment. We have the balanced portfolio in the middle grounds at 14% return, and our growth portfolio posted the highest return of 16.1%, as expected based on the balance of these portfolios. Now, if we were to look at this and project that in 2020, we have a negative year. Let's assume that 2020 goes by and the broader market is down. We enter into a recession, into a crash, and investments across the board are down. Well, correspondingly, what we could expect is that our safer portfolio, consisting of 70% fixed income, these are obviously hypothetical numbers, but this one would be down, let's just say it's down 9%. It sees a 9% loss on the year. Our balanced portfolio, let's assume this one's down somewhere along the lines of 19%. It saw about a 20% decrease. And our equity portfolio, our aggressive, more growth-oriented portfolio, of course, being the polar opposite of a good year, this one would experience the biggest downfall. And in this case, let's assume it's a terrible year. This portfolio is down 30%. Now, with all of this info and insight fresh on mind in terms of recovery time and now how much is expected, I wonder if that changes at all your opinion on which is the better account to go for, the safer one, the middle tier, or the high one. It's just something to factor in, okay? And I'm not trying to tell anybody here what they should or shouldn't be doing and what type of strategy they want to implement. It ultimately comes down to you. But I really hope this is a little bit eye-opening in terms of just how important it is to mitigate and manage the downside. Because again, digging out of those holes, it can be a little more difficult than when you think. And I came across actually a good example that this one kind of relates to some maybe online people, some YouTubers that you hear about who are just bragging about all their returns. I'm up this much percent, this or that, which is something we really try not to do on this channel. We try to take that slow and steady approach for this exact reason. But let's assume, looking at a 2-year period, let's assume that in year 1, you made 100% return on your investment. So your portfolio was up 100%, you had a great year, and you actually doubled your money. So from $100,000 to $200,000. Stellar year, you're a great investor. Everybody should be copying your results because you are an awesome investor at growing your portfolio. Now in year 2, if we were to enter into a crash and your portfolio was down 50% because your investments were so aggressive, because they were shooting the lights out, a 50% loss would bring that portfolio back down to where we started at $100,000. Now, what's crazy is that if you were to look at the average return over this 2-year period, this doesn't tell you anything close to the real story because you're back at where you started. Again, because these losses, they do hurt so much more than the gains. And that's really what I wanted to share with you guys in today's video. Again, I apologize for the terrible video from my phone with no office setting, with no microphone. I did just want to throw something up because this is a video that I've been wanting to share with you guys for quite some time. To me, this is one of the most valuable lessons that I can remind myself when you see people bragging about their gains, when you see channels on YouTube that are posting all of these hot stock picks that are always surging up and they're doing so well. Let's keep in mind, guys, the past 10 years have been an amazing market for growth. It's been a haven for growth investors, and this is something that I just think a wise, prudent investor would keep on top of mind. Whether you're just starting out or whether you are even a seasoned investor, it's good to remind yourself that sometimes this slow and steady, medium ground approach beats the hare that's the tortoise and the hare. You know the story, the person that's trying to shoot the lights out. Apologize again for the crappy video, but if you guys enjoyed it and you learned something new, feel free to give this one a thumbs up. That is a great way of supporting the channel. If it's your first time here, subscribe. And if you are somebody that's looking to actually learn how to build a well-diversified portfolio, if you are thinking to yourself that maybe you could invest a little more responsibly, or maybe you're just starting out and you don't even have a portfolio, you don't even have your investment account set up, click the first link down in the description below. to learn more about our Investing Academy, because we're working with students going through the entire process of setting up their accounts. First of all, understanding the basics, the fundamentals, the terminology, and then actually going click by click in opening their accounts, funding the accounts, setting a strategy, setting a proper balance that works for you, and ultimately having them go on their way and being successful and confident in their own investing abilities. That'll be that first link down below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.